Imagine waking up to find out that one single customer basically controls most of the money coming into a company you invested in. Not 10%, not 20%, more than half. And if that customer pulls back, delays orders, or switches suppliers, the stock can get wrecked overnight. That's the quiet risk sitting behind the AI hype around supermicrocomputer. On the surface, everything looks explosive. AI infrastructure demand is booming. Data centers are scaling like crazy. Companies are racing to deploy GPU clusters to train and run AI models. Supermicro built its growth story around high performance AI servers and modular rack systems, which made them a go-to supplier during the AI rush. Revenue surged. Wall Street took notice. Retail investors piled in. The narrative felt unstoppable. But when analysts started digging into the revenue structure, one detail stood out. A massive portion of sales is tied to a very small number of customers. When a single client contributes somewhere around half, sometimes even more, of total revenue, that creates dependency risk. And dependency risk isn't loud until it suddenly is. Here's why this matters. Large hyperscale cloud providers and AI infrastructure companies don't operate on loyalty. They operate on cost, performance, supply chain reliability, and strategic leverage. Today, they may place huge orders. Tomorrow, they may diversify vendors, negotiate pricing pressure, or delay deployments. Even a timing shift can shake quarterly earnings. If a major customer pauses orders for one quarter, revenue can miss expectations. That leads to analyst downgrades. That leads to sentiment turning negative. And sentiment moves stocks faster than fundamentals. We've seen this pattern before across the tech supply chain. Suppliers surge during demand spikes, then get punished when customer spending cycles normalize. And AI infrastructure spending is cyclical, even if the long-term trend is bullish. Another layer to this risk is pricing power. When one customer represents a huge chunk of your business, they hold leverage. They can push for discounts, better payment terms, priority delivery, or custom configurations that compress margins. That means revenue can grow while profit margins shrink. Investors celebrating top-line growth may suddenly realize the bottom line isn't scaling the same way. Now let's talk about diversification. If revenue is spread across dozens of mid-sized clients, risk is distributed. Losing one account hurts, but it doesn't destabilize the business. But when revenue concentration is high, volatility risk increases. One delayed deployment, one contract renegotiation, one shift to a competing hardware vendor. That's all it takes to create earnings surprises. And Wall Street hates surprises. There's also the strategic risk factor. Major AI infrastructure buyers often design multi-vendor ecosystems. They don't want to depend on one hardware provider. That means even if Supermicro is winning big today, customers may intentionally reduce reliance over time, not because performance is weak, but because diversification reduces their own risk. That's standard enterprise strategy. Customer concentration risk doesn't automatically mean the company is in trouble. In fact, it often shows that the company has secured high-value enterprise contracts, which is a sign of trust and technical strength. Landing massive AI infrastructure clients isn't easy. It requires engineering excellence, reliability, and the ability to deliver at scale. So the same factor that creates risk also proves credibility. That's the twist. Heavy reliance on one major client can be a warning sign, but it can also be evidence that the company is deeply embedded in critical AI deployments. The real question investors should ask isn't whether concentration exists. It's whether the company is turning early mega clients into long-term diversified growth. Watch for new enterprise customers, expanding global demand, margin stability, and whether backlog growth is coming from multiple sectors. If concentration declines while revenue rises, risk drops and confidence grows. If concentration stays high and margins tighten, volatility risk remains. In fast-moving AI markets, today's biggest customer can become tomorrow's smaller slice. If execution stays strong, but if expansion slows, dependency becomes a pressure point. That's why smart investors don't just watch revenue grow. They watch where the money is coming from. Because sometimes the biggest risk isn't in the headlines. It's hidden in who's actually paying the bills. If you're riding the AI wave with SMCI, keep watching diversification trends, margin movement, and customer mix. That's where the real story is unfolding.